Hey, and welcome to another video here at Fiscal Voyage. I'm Felix, and today we're going to talk about IBM. Thank you, Young Yim Chu. I hope I'm saying that correctly. Thank you again for suggesting IBM. So we're going to do a 5-minute stock analysis on IBM to determine if it's a buy, hold, or sell at current prices right now. All right, let's start the 5-minute stock analysis of International Business Machine Corporation, also known as IBM. The stock symbol is actually IBM, and IBM is an American multinational information technology company headquartered in Armonk, New York. I think I'm saying that right. With operations in over 170 countries, the company began in 1911, founded in Endicott, New York, as Computing, Tabulating, Recording Company, CTR, and was renamed International Business Machine in 1924. IBM incorporated in New York. IBM produces and sells computer hardware, middleware, and software, and provides hosting and consulting service in areas ranging from mainframe computers to nanotechnology. IBM is also a major research organization holding record for most U.S. patents generated by a business as of 2019 for 26 consecutive years. Innovations by IBM include the automated teller machine, ATM, the floppy disk, hard disk, magnetic strip card, relational database, the SQL programming language, UPC barcode, dynamic random access memory, the IBM mainframe exemplified by the System 360 was the dominant computer platform during the 1960s and 1970s. The most recent acquisition for IBM has been PwC Consulting in 2002, SPSS in 2009, the Weather Company in 2016, and the most recent Red Hat earlier this year. Let's look at its fundamentals. Revenue grew or didn't grow at a negative 2.03% from 2009 to 2018. That's why the stock price actually has been lower and or flat in recent years. Net income grew or was lower at negative 4.067% for that same time period. However, the company has a credit rating of A, which is investment grade, great credit rating. Earnings didn't grow also. It has a negative 0.56% in that same time period. However, earnings 5-year average is much more dramatic at a negative 8.62%. Last year, the company had adjusted earnings of $13.81. Net margin came in at 10.97, which is has been expanding versus 2017 of 7.27%. And ROE at 50.76%. Debt to cap at 68%, which is fair, not too high, but it's getting there on the high side. The current yield is a great yield at 4.82%, and they have a great payout ratio at 50.6%. And the 5-year dividend average is 3.8, so you can get the stock at a much more attractive dividend yield at 4.8. However, the most recent dividend increase was 3.18% in April, but they've been growing dividends for 24 consecutive years and has a 5-year dividend growth rate of 10.9%, which gives us a Childer rule of 15.72, which is much more higher than what I like to look for at 12. So that's good there. The future outlook for the end of 2019, earnings are expected to be lower than 2018 at $12.80. However, they are picking it up at 2020 with expected earnings of $13.31 a share. The projected earnings per share growth for the next 3 years is projected to be 1.4%. And in my calculation, I added that 1.4% for the dividend drill return model, and it came out to 10.7% in projected return, which is great. I like to see it above 9 or greater, and we're getting 10.7 here. The current PE is 10.51, and we have a forward PE of 10.11 versus a 5-year PE average of 14.44. Based on that, we could see that the company is slightly undervalued here. Let's look at the fast graph. Fast graph has the black line is the monthly closing price, the blue is the normal PE, and the orange is the earnings with a PE of 9. As you can see here, the black line is in between both, so that's kind of like, in my opinion, fairly valued. Let's see the prices here, or the fair value prices. CRFA has 138, Morningstar 128, Simply Wire 197, which is quite high actually in my opinion. Fast Graph at 141, Yahoo at 148. My dividend discount analysis at 95, based on the lower expected growth, in my opinion, of about 3 to 4%. So we have a fair price of 141 and 54 cents, which is actually higher than the current price of 134 and 45. Basically, the stock is undervalued by roughly 5%. I like to see it close to 10% or higher undervaluation, but I recommend it as a buy because I think the company is turning around with the investment of Red Hat. I see now earnings to be much higher, revenue coming in higher, the great dividend yield. So like I said, the earnings for 2020 and 21 is expected to be higher. I love the safe payout ratio of about 50%. So therefore, I think it's a buy at current price, nice dividend yield, and the history and low payout. And the Red Hat acquisition should be tremendous growth potential for the company. So thank you for watching, and if you find this video informative, please hit the like button and subscribe to my channel. If you have another company you would like for me to analyze, let me know in the comments below. And take a look at my website, physicalvoice.com, and you can check my portfolio in the link in the description below. Happy investing, guys.